Okay, let's dive into this. Welcome to this explainer. Today we're mapping out one of the most wild transformations in modern finance. For years, the digital asset space was basically stuck in regulatory purgatory. But we're going to trace how this massive global ecosystem dragged itself from total chaos into an era of structured order. It's literally the story of century-old laws slamming into bleeding-edge tech and how policymakers finally sat down to build a real framework for the future of money.
So here's the big dramatic question. How do you regulate a decentralized financial revolution? Honestly, for a long time, the US strategy was just regulation by enforcement, reacting to the mess after it happened with lawsuits. But as the demand for things like on-chain dollars skyrocketed, this intense geopolitical urgency kicked in. Policymakers woke up to a stark reality. If the US didn't create a clear, regulated home for digital dollars, all that innovation was going offshore. And if we let that happen, it could totally erode the global dominance of the US dollar in the next era of finance.
The contrast here is just night and day. Think back to pre-2025. Total Wild West. We watched high-profile, catastrophic collapses like Terra and FTX, and a wave of algorithmic stablecoins with, let's be real, super sketchy backing. It exposed massive systemic risks. But now, post-2025, we are stepping into a totally new, regulated era. We're talking digital dollars, serious institutional backing, and the actual rule of law. The conversation completely flipped from whether we should regulate stablecoins to how we can do it while still letting innovation run wild.
Which brings us to Section 1, from orange groves to blockchains.
Okay, so before we look at the future, we actually have to jump way back to 1946. That's when the Supreme Court ruled on the Howey case. And crazy enough, this was about an investment scheme in Florida orange groves. It gave us the four-prong Howey test to figure out what an investment contract actually is. You need 1, an investment of money, 2, in a common enterprise, 3, with an expectation of profits, and 4, derived from the efforts of others. For decades, this just quietly operated in the background of traditional finance. But suddenly in the digital asset boom, this vintage, century-old test became the ultimate legal battleground for tokenized assets.
And this brilliantly illustrates how traditional legal frameworks seamlessly map right onto bleeding-edge tokenized assets. Look at equity tokens, unambiguously securities. They check all 4 Howey boxes. You invest money in a common enterprise, and you're expecting the management team to turn a profit. Debt tokens, also securities, usually under a related pin called the Reeves test. Revenue share tokens are where you get the most debate, but honestly, because you're banking on the project team's efforts for your payout, they almost always fall right under the securities umbrella too.
So, here's the absolutely crucial takeaway. Tokenization does not create some magical regulatory escape hatch. You can't just put a security on a blockchain and call it a commodity. It doesn't work like that. The underlying economic reality is all that matters. The real genius of tokenization isn't dodging the law. It's about executing securities regulation way more efficiently. We're talking automated compliance, real-time reporting, practically zero administrative bloat. The tech itself is legally irrelevant to what the asset is, but it is a massive upgrade to how the asset works.
All right, moving on to Section 2, the Genius Act breakthrough.
Fast forward to July 2025, and the Genius Act becomes law. The absolute heart of this legislation comes down to a simple ratio, 1-to-1. The act laid down a strict, non-negotiable 1-to-1 reserve requirement for payment stablecoins. That means for every single digital dollar out there, the issuer has to hold at least 1 actual dollar's worth of highly liquid, low-risk assets. Think insured U.S. bank deposits or short-term treasury bills. By forcing this absolute gold standard and demanding public audits, the government essentially wiped out those terrifying depegging nightmares we saw in the past.
But here's where they ran into a really fascinating dilemma. How on earth does a traditional court enforce a ruling on a decentralized, censorship-resistant blockchain? Well, the Genius Act solved this with a brilliant concept called administrative hooks. These are essentially smart contract superuser functions. So instead of trying to alter the base layer of the blockchain, which you really can't do, the law says issuers have to build these specific hooks directly into their tokens. This lets a regulated issuer free specific wallets or illicit assets if they get a lawful court order. It's a remarkably elegant way to bridge the gap between immutable code and our real-world legal system.
And that brings us to the horizon, which, honestly, is incredibly exciting. Because of innovations like those administrative hooks, we're transitioning from the old, clunky compliance as filing model to continuous compliance as code. Picture this. Investor rules are literally embedded directly into the token itself. With standards like ERC 3643, if you try to transfer a token to a non-compliant or sketchy wallet, it's not just illegal, it's technically impossible. The smart contract simply refuses to execute the trade. No way around it. For builders and investors, compliance just becomes this frictionless, automated property of the asset. Just look at how fast all this clarity materialized. In January 2025, the Trump administration issued an executive order that officially ended the era of regulation by enforcement. Then in March, another executive order established a strategic Bitcoin reserve, which clearly signaled that digital assets were now being viewed as strategic national reserves. Then the Genius Act hit in July, and by March 2026, the SEC and CFTC finally teamed up to issue joint guidance, giving us a comprehensive taxonomy for crypto assets. Objectively speaking, this rapid sequence of policy shifts acted as a massive green light for the market. It de-risked the industry almost overnight and finally gave conservative, legacy institutions the confidence to start building on-chain.
And that leads us to Section 3, Laboratories of Democracy.
You know, while Washington was grabbing all the massive headlines, a lot of the most creative legal heavy lifting was happening quietly at the state level. Justice Louis Brandeis really hit the nail on the head back in 1932, and he said, "A single courageous state may serve as a laboratory and try novel social and economic experiments." Our federal system can definitely feel like a messy patchwork sometimes, but for digital assets, this exact philosophy was a game changer. The states didn't sit around waiting for the feds. They rolled up their sleeves and started testing entirely new legal frameworks.
Wyoming and Texas are perfect examples of this, and they took completely different approaches. Wyoming went full mad scientist experimental, passing the Dow LLC Act back in 2021. They literally gave decentralized protocols actual legal standing, meaning when token holders vote on-chain, they are exercising real, recognized legal rights under state law. Wild, right? Texas, on the other hand, went straight for pro-business clarity. They legally defined virtual currency as property and carved out bulletproof statutory protections for Bitcoin miners. So whether it's Wyoming inventing novel entities or Texas rolling out the red carpet for business, these state-level experiments were absolutely crucial in pushing the whole industry forward.
Let's move to and see how this builds on the international stage with Section 4, the global regulatory mosaic.
Because obviously, the US isn't operating in a vacuum here. If you're structuring tokenized assets today, you have to navigate this incredibly complex global mosaic. And honestly, every single jurisdiction has its own distinct regulatory personality. Over in the EU, you've got MiCA for stablecoins and a DLT pilot regime testing the waters for securities. The UK is taking a very measured, careful approach with their digital securities sandbox. Singapore is acting like the principles-based mentor, offering real-time, hands-on guidance. Then you have Dubai going for maximum ambition with purpose-built frameworks and, 0% capital gains tax. Meanwhile, Switzerland is just doing what Switzerland does best, precision and permanence, literally hard-coding ledger-based securities into their statutory law. It's a fiercely competitive global map out there.
But hey, before we get too starry-eyed about all this new regulatory clarity, we need to ground ourselves. Welcome to Section 5, the tax reality check.
Because here is the question that ruins literally every good crypto party. What about the IRS? Having clear rules for stablecoins and securities is absolutely fantastic for sure, but do not make the mistake of thinking regulatory clarity automatically equals tax simplicity. It doesn't. In fact, figuring out exactly how the taxman views your tokens is easily the most complex, headache-inducing layer of digital asset compliance.
The whole foundation of U.S. digital asset tax law rests on IRS Notice 2014-21, and it states, very simply, that virtual currency is treated as property, not currency. Now, that has massive everyday implications. It means every single disposition, whether you're selling a token, swapping it for a different one, or literally just buying a coffee with crypto, boom, that's a taxable event, triggering a capital gain or loss. Oh, and the IRS also made it crystal clear that staking rewards, those count as ordinary income the exact second they hit your wallet. So we're talking about traditional property taxation being forcefully applied to a hyper-fast, high-velocity digital world.
Now, what's really interesting about this slide is a massive, gaping discrepancy that exists right now. See, traditional securities are subject to the wash sale rule. If you sell a stock at a loss, you can't claim that sweet tax deduction if you just buy the stock right back within 30 days. But because digital assets are currently classified as property and not securities for tax purposes, that wash sale rule doesn't apply to them right now. It's this bizarre, temporary, but hugely significant loophole. You can literally dump a digital asset at a loss to harvest it and immediately buy it back. Though, fair warning, tax practitioners are screaming that Congress will absolutely close this gap in future legislation.
And if you're managing a tokenized fund, the hurdles are just immense. Look, blockchains are beautifully, perfectly transparent.
But that transparency doesn't magically vaporize tax complexity. It just yanks it out of the back office and relocates it straight into the smart contract and right into the investor's lap. Funds have to track real-time distributions flawlessly. They have to sweat over inadvertent taxable events if cost basis transfers aren't perfectly synced. And international investors? Blockchain rails don't erase U.S. tax law, so you still have to manage those brutal 30% withholding obligations. This is exactly why you're seeing private placement memoranda get so thick with tax disclosures lately. If you're allocating capital in this space today, your due diligence literally demands that you understand smart contract tax mechanics.
So what does this all mean for the future? As century-old laws finally collide with immutable blockchains, and this whole idea of compliance as code transforms the digital frontier, is traditional financial regulation forever changed? We've clawed our way out of the Wild West into this new era of strict reserves, programmable compliance, and fierce global competition. The technology didn't let us escape the rules like some people hoped, but it just might be completely rewriting exactly how those rules are enforced for generations to come. Thank you so much for joining me for this explainer. I really hope it gave you a solid, powerful framework to understand the regulatory dawn of digital assets. Catch you next time.